The US economy is starting to show signs it may begin to crack soon as an economic crisis going into 2025 is brewing. The first major crack appearing in the foundation of our economy is this chart right here, which, as you can see, for over 60 years has been heading lower and lower. But rarely does it ever go below zero. You can see it went below zero during the great financial crisis. It briefly dipped below zero during 2020 and has now been sustained below zero for almost 2 years. This chart is the net savings as a percent of gross national income. Now, you as an individual, you might be able to sustain for some time spending more than you make. But usually that's because you have some prior savings. Once you bleed through those savings, then you might go towards debt and borrow in excess of your income so you can continue spending more than you make. But eventually that road will run out as well, which is why a dip below zero is simply not sustainable. It is an economic law that you can only consume what has been produced. And if you as an individual are consuming more than you're producing, you are by definition consuming something that somebody else has produced. But you cannot eat more bread than the bread that is made. And you cannot, as an entire economy, consume more than is being produced without seeing a crash, which is why the last time we dipped below zero was in 2020, and before that was the financial crisis. But that's not the only savings metric that is showing signs of trouble. If we take a look at the personal savings rate, which is a measure of personal saving as a percentage of disposable income, we can see that it is rarely below 5. It dipped below 5 leading into the great financial crisis, and it has been stuck below 5 ever since 2022. From a household finance perspective, this means people are being stretched. Considering the fact that for about 4 years now, the cost of living has increased at a faster rate than wages, it stands to reason that people have not been able to save and have been spending more and more and are being stretched to their limits. Which leads us to the second crack in the economic foundation that is showing right now, which is debt. Yes, there are problems with the national debt. Yes, there's some issues with corporate debt, but the biggest issue is consumer debt. Individuals, people who have more debt than they can afford. And the reason why this is a bigger issue than corporate debt or national debt is because the government can always print money to cover its debt, and corporations have access to bailouts, they have access to bond markets. Individuals don't. Real quick, guys, I do need to inform you of something very important coming up in just a few days. It's no secret that we are facing one of the most contentious elections in US history. Two candidates could not be more different from each other, and the polling odds are changing by the day and changing by who's doing the polling. That's why on November 3rd at exactly 7 p.m. Eastern time, this is just 2 days before the election, I'm hosting a live Zoom call to detail something I call the election chaos trade. It's a special trade that has historically soared in the months following an election. In fact, in the past, this trade has thrown off gains as high as 173%, 363%, and even as high as 1,455% in a matter of months following the election. And even though massive 1,000% plus gains are the exception, they are not the rule. I want to show you why I think this year's election chaos trade could be the biggest one yet. If you're interested, simply click on the link in the description below, register for the event, and show up on Sunday, November 3rd at exactly 7 p.m. Eastern time. Attendance is completely free, but seats on the Zoom call are limited. Can't wait to show you this opportunity. Look forward to seeing you there. Total household debt in the United States rose yet again and is almost $18 trillion, including housing debt. When we break it apart by the other forms of debt outside of mortgages, we see literally every form of debt increased. Student loans are at $1.58 trillion. Credit cards are at $1.14 trillion. And auto loans are at $1.63 trillion. There's even an entire other category of debt at over $0.5 trillion. The amounts of debt here are absolutely staggering, and quite honestly, just by looking at the numbers, we don't really have a way to interpret what that means. So let's break it down a little bit. On the over $1 trillion of credit card debt that Americans are carrying, they're paying an average of 21.76% interest on that. Now imagine for a moment that you could reliably get a 21% return on an investment. You pick a stock, you buy a rental property, you're getting a very predictable 21%. That is so rare, it almost doesn't exist, especially in public markets. Maybe some years you get that, but it's not consistent. But that is exactly what people are paying the banks. In other words, individuals who carry credit card balances are that investment for banks. So not only is credit card debt increasing, the cost for that credit card debt for the American household is also increasing, which is why for the last couple of years, delinquency rates on credit card loans have also been increasing, and they are at the highest they've been in over a decade. Like I said before, Americans have spent through their savings, have not been able to have their income keep up with the cost of living, have loaded up on debt in order to bridge the gap, and are now paying the cost and are no longer able to afford it. And if it just stopped at credit cards, that would be fine, but it doesn't. Edmunds just came out with a report showing negative equity for auto loans is on the rise, and it recently just hit an all-time high, and upside down car loans recently just hit an all-time high. Insane numbers here showing that 1 in 5 vehicle trade-ins with negative equity are underwater by $10,000 or more. In total, of all of the trade-ins that happened during Q3 of 2024, 24% of them had negative equity. That's basically a quarter. 1 out of every 4 people who traded in a car last quarter, they had negative equity, which meant they owed more on the car than the car was worth. And of those people who were underwater, on average owed $6,458, which means if they were able to take that car, sell it on the open market, take that money, pay that towards the loan, they would still owe, on average, over $6,000. And 1 in 5 of consumers that had negative equity owed more than $10,000. And a staggering 7% of vehicle owners with negative equity owed $15,000 plus. 1 out of every 4 people who traded in a car last quarter had negative equity. And of those people, 7% of them owed $15,000 on top of what their car was worth. Look, I understand that times are tough, but one of the reasons times are tough is because many individuals have made really stupid decisions. Yes, there are things outside of our control, things happening economically, but that doesn't mean that you are not able to make good decisions still and have good outcomes despite what's going on in the world. And if your car is worth $10,000 less than what you owe on it, the first place you should be looking for a solution is in the mirror. Now, if savings and debt and interest rates and delinquencies and car loans and all of that were where it is, but people were having better and better job opportunities and there was growth in the economy, then that would be one story. Unfortunately, that's not there either, which is the third place we see massive risk in the economy right now, the jobs market. People who are working part-time jobs are near an all-time high right now, well above the average that they were at for almost a decade. Meanwhile, full-time job growth has stagnated, which means full-time job growth in the United States is not growing, and people are making up the difference by getting multiple part-time jobs. These jobs pay less and have no benefits, all because they're scrambling to keep up with the cost of living, and it doesn't even stop there. We also see continuing jobless claims in the United States continue to notch higher and higher. Now, it's important to note that markets are not the economy, and the economy is not the market, which is why despite these risks that everybody has access to see, the S&P 500 is at all-time highs. The NASDAQ is at all-time highs. Gold is at all-time highs. Bitcoin is knocking on that door. And heck, even real estate is still at all-time highs, which is why they say markets climb a wall of worry. It's when everybody is extremely optimistic and even euphoric about the markets that they tend to collapse, not necessarily when the economy is showing signs of stress or fracture. And to be honest, if you're positioned right, wild short-term swings in asset prices can be opportunities to profit, whether the swing is up or down. This is why I've never recommended to my members of my private program, Heresy Financial University, never recommended them to get net short the market. We always stay long, stay hedged, stay uncorrelated, and most importantly, stay positioned to take advantage of wild swings. And speaking of that, make sure you are signed up for the Election Chaos Trade event just a couple of days away. If you're not, use the link in the description below. As always, thanks so much for watching. Have a great day.